Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at a UOA today, unusual option activity in Qualcomm QCOM, where some massive, especially on the call side, option buying spiked implied volatility to extremes, and a couple ways to best capture the vol, one in a defined risk way, the other in a delta neutral and well out of the money fashion. So let's jump in and take a look, shall we? As we always like to, we take a look with our fusion approach at fundamental, technical, and in this case, most importantly, implied volatility analysis. So taking a look, here's our scanner. Here's the one I built on Thinkorswim. As you can see, Qualcomm lighting it up as far as the unusual option activity. So this is basically volume that has increased the implied volatility, right? Unusual volume along with a jump in IV or the price of the option. So here's Qualcomm, the biggest one, over 11,000. Here you can see Qualcomm all over the place. I have another scanner that I use. I didn't build this one. Qualcomm number 2 on the list. You can see over 500,000 option contracts traded today, right? News that they may not have partnerships, right? Their chips are being used like all the other chips out there. The chip sector, certainly the kind of forgotten names, red hot, right? As AI certainly going to the forefront, but these stocks may be getting out over the skis a little bit. But you can see over 7.5 times the normal volume, right? So certainly big unusual option activity. And you can see here the implied volatility at the highest level in the past year, that huge jump of over 20 vol points on the IV certainly makes option prices more expensive, favors selling strategies when looking to structure the trades. We'll take a look in a second just how much IV has spiked here. We like to look certainly at the valuations, as we said. So here's just a quick look at Qualcomm. This is post earnings. They had very good earnings, right? And they do have deals down the road like every other chip maker out there, right? But you can see on a price to sales basis, now even after those revenue numbers that were a beat are factored in, still trading at by far the highest multiple over the past year, almost 5 times price to sales, right? Normally trading under 4 times PE, right? On a 5 year chart, you can see first time over 40 on a price to earnings basis. So certainly valuations getting pushed to an extreme here, and these do factor in the latest earnings beat, as we said. So valuation certainly not cheap and getting stretched here. On a technical basis, right? You can see the price action today. Stock traded up to 223.66, reversed swiftly, did close up nicely on the day, about 5% or so, but did have that pullback. That kind of marks maybe a sign that enough is enough up here, right? So it might be tough to plow through there again, certainly over the short term. But the other metrics certainly looking overbought too. You can see trading at a massive premium to the 20-day moving average. 9-day RSI reached an extreme, softening a little bit, but not much. Still at by far the highest level over the past year. MACD, by far the highest level over the past 12 months. Bollinger percent B, still over 100, and that's even with IV at the highest level, and that's post earnings, right? Earnings, as you can see, were a very nice beat. The stock did rocket higher, right? Broke out past that 180 level to break out to the upside. But as you can see, all the metrics getting stretched, and implied volatility even after earnings, right? Certainly at the highest level by far we have seen over the past year, favors option selling strategies. Speaking of IV, we always like to take a look at that. So I took a look at a couple IVs. Here's the 60-day IV. You can see over the past 12 months just ripping to the upside as certainly volume flying in, option prices, which is a fancy way to say implied volatility, right? Getting to extremes, right? The highest level by far over the past year from Wednesday to Thursday, you can see that huge lift higher, right, from under 55, right, to well over 60. So a huge jump in IV. Taking a look at it on a different perspective, here's kind of a 20-day look at IV generalized, right? You can see here is the normal vol crush. Here's earnings, right? IV normally heads higher into earnings as the unknown, right? People tend to hedge, usually do it right in front of earnings, as you can see here. Then post earnings, you get the vol crush as the unknown becomes known. That happened here normal, but then we got the vol rush after the vol crush. IV now ripping higher, and you can see that massive run up in IV as far as the move from under 55 to over 60, as we said. So just a massive rush to buy mostly calls, as we'll see in a second here. Here's our June, which is one of our months that we're going to use for one of our trade ideas, right? You can see IV moving up 20%, massive volume there. Current IV percentiles, we said 100% options have not been this expensive over the past year. We'll take a look at the chart in a second, and you can see calls certainly dominating over puts as far as volume, right, on about a almost 3.2 to 1 basis, right? So big call buying, right? And you can see here too, the call IV right now is higher than the put IV, which is not normal either, right? Before, you can see it wasn't nearly to that extent, but ever since all of a sudden we saw this huge rush higher, right, by all the chip makers, calls are far outpacing puts, so call IV racing up to the upside as well. So here's a look at a 60-day 30 delta call you can see over the past 2 years on this chart, right? So you can see that it's at the highest level, no doubt at all, over the past 2 years by far. The only previous times you can see here, as usual, on the spikes in IV, it tends to revert very quickly. We look for this to happen again, right? Here's a shorter 6-month look at that. You can see both the puts and calls, right? You can see both spiking ridiculously high, in my opinion, over the past day, right? And now calls trading at a much higher IV than the corresponding puts, right? So again, upside IV far outpacing downside IV, also a sign that maybe that huge rip higher may be coming to an end, right? So one of the trades we like is a simple iron condor trade going out to June, right? 42 days, selling the 180, 175 put spread, right? Stock closed a little bit over 200, right? So you have about 22 points of downside cushion, right, for 42 days. And to the upside, the 250, 260 call spread. Combining those two, you get about $3.50 on that trade, right? The nice thing about that huge jump, as we said, in implied volatility, you can get further out of the money for the same net credit on spreads, get the same out of the money with a bigger net credit, or how we like to do, get a little further out, a little bit bigger cushion margin of safety, and a little bit more net credit, right? Try to get the best of both worlds, if you will. So selling that iron condor for about $3.50, right? That's your maximum gain, right? Maximum risk, since it's 10-point wide spreads on either side, right? Only one side can get in trouble. 650 max risk. So your return is over 50% return, 42 days to expiration. Your upside break even, 250, 350, which is simply the 250 strike price plus the 350 credit you're selling it for, right? Downside, the same thing there, 180 less the 350. Your upside gives you about 50 points or so of upside cushion from here above even that kind of spike intraday high that was met with some selling, right? We're up here with our strike price for basically a little bit over a month, so we have plenty of upside cushion. Our downside is struck right here, which is kind of that breakout level, right? Earnings were a very nice beat, as we said, and certainly, as we know, stocks tend not to go down much in this market, so we're leaning a little bit bullishly, if you will, but in a guarded fashion, right, by having defined risk trades. So our upside break even 25%, downside about 12.5%. So that's certainly a very defined risk way to trade it. 650 at risk to make 350 with plenty of cushion to either side on a stock that looks like it may have finally seen its comeuppance here, and really looking for that IV to move back down, which will collapse the spreads as well. Another way to play it is going out longer term, right? And you know, from previous videos, I like to go very long term to take advantage of these massive vol spikes. Doesn't mean at all you're going to hold it long term, but you get such a big margin of safety, and it reverts just as quickly, if not more so, long term when vol comes in. So taking a look at the 360-day IV, right? Because we're going to be going out to January of 2028 on this next trade. You can see this massive spike, right? It was hugging around the mid 30 level, right? Had that run up, the little vol crush back, and then lo and behold, a massive move higher of 10 vol points, basically, simply because of all that big volume coming in, bled across the entire term structure volatility. Here you can see it on a 6-month basis, the calls and the puts both, right? That huge spike, right? Had never ever seen this before, and calls trading at a much higher IV than puts. So that sets up for a sell strangle. You will be naked a call and a put both, right? So you have to be approved for it option wise, but certainly I think it makes a lot of sense. So I simply went back to May 2nd with the stock at 177.01, selling the 300 call that expires January of 2028, and the 200 put in the money put, right, that expires January of 2028, right? And you could have gotten a little bit more than 60 bucks back then. IV was in the low 40s, right? And the stock, as I said, at 177.01. So the put, 23 points in the money. The calls, you know, 123 points out of the money. Fast forward to yesterday, right? We see the stock 202.55. So now the put is slightly out of the money, right? It's moving towards that area you want it to, between 200 and 300. The call's still well out of the money, but yet that sell strangle jumped to 69. So you have the stock move favorably as far as you'd want to from a price perspective, right? The put no longer in the money right now, it's slightly out of the money. The call is still well out of the money, but that sell strangle jumping by about 8 points. So I think this is certainly a way to capture the vol in a big way, right? Just look for it to come back. 4 vol points is all we're looking to do here. So put the two together on May 2nd. As you can see, the stock at 177.01, that sell strangle, selling the January of 2028, 200 put, and the 300 call. Could have gotten a little bit more than 60 bucks. You would have been 20 deltas net long going back to that day, right? Selling a negative 47, so you're plus 47. Selling at 27, right? So you'd be 20 deltas net long, so a bullish trade. Fast forward to yesterday, or the close earlier today, right? You can see that delta now 35 selling it, so you're plus 35 minus 39, so you're 4 deltas net short here. Smooth delta, you'd be about 8 deltas net long. The stock goes up, right, 25 points, right? You'd expect this strangle to drop in price to be profitable, right? You're long, right, generally over that move, right? The stock goes up fairly significantly, but yet if you would have sold the strangle earlier, you'd be down about 7 bucks. Why? This huge jump in implied volatility from under 42 to almost 48. So that's what we're looking to capture here, right? And a simple way to do it, as I said, sell the 200 put, 300 call. So I simply took a kind of theoretical look at it, right? So here's where everything closed at, right? With the calls at 26.59 and the puts at 41.20. So roughly around 68 bucks or so, give or take, right? If we would lower the IV just 4 vol points, right, going on the call side, right, from 49.32 to 45.32, and the puts same way, 42.07 before they were at 46.07. So we're just looking to drop IV back down, right? Just moving it back down to a level here, right? We're up around the 50-ish level, 45-ish or so, right? You're not even back down here at all. Just a simple 4-point drop in IV would move that strangle out in January of 2028 from the current price around 68, 69 bucks, right, to about 60 bucks or so. So a very nice $7 simply by having IV, which had gone absolutely parabolic here, right? Just looking for it to come back to this area here. If it drops further, even better. So I think that's the trade we're certainly going to try to put on tomorrow as well. We'll let you know how it goes. And here you can see, kind of as we always like to do, doing that trade one time, right, selling the 300 call, 200 put, would tie up about $4,000 in margin requirement as long as you're approved for it. So certainly the ability to maybe make 700 bucks on 4,000 just on reversion and IV makes sense to me. So that's how we go about identifying trade possibilities here. Like to do it in a fashion where we find the edge, put on the hedge, or in this case, with that long-term naked sell strangle, give ourselves plenty of cushion, right? As we said, we have massive upside cushion on the trade, right? Where basically have the stock can move up another 100 points by far, and we still wouldn't be in trouble, as we said. So again, we'll see what happens with this. As we always like to trade, say though, trading is all about probability, not certainty. So make sure you position size accordingly, and make sure you know where to get out, or you shouldn't be getting in. So until next time, as always, here's a good trade.